we are live. Can you hear me okay? It seemed like I was having a little bit of a glitch there. Can you hear me okay?
I can hear you just fine. Can you hear me okay?
Yeah. It's just normally I hear the intro. I usually hear a little bit of a reduction there, hearing it back. It was just kind of weird how the noise was. But Brent, thanks so much for coming on to a real estate power play. Thank you for coming on this late in the evening, Monday evening. So I appreciate it. And I'm excited to have you on, especially, we've been going back and forth talking a little bit about, setting up the proper entities, asset protection, taxes. And you guys, I think this is going to be great for everybody to kind of listen to so they have a really good understanding exactly how the whole process goes here. So Brent, why don't you tell me, go ahead and introduce yourself, talk a little bit about yourself, and we'll go from there. I appreciate you on.
Well, yeah, no problem. First off, thanks for having me. I really look forward to the opportunity to share some really quality information and opportunity to help business owners, entrepreneurs, investors across the country. Like many of you, I am a business owner with multiple investments, and I started my company, Corporate Capital, December 1st of 2013. So we're going on 10 years here in Las Vegas, Nevada. We do work with clients in all 50 states and some international as well. We specialize in corporate formation. So we set up corporations, a lot of LLCs in this day and age with the flexibility that they have. We offer those services in all 50 states. My partners are CPAs and accountants. So I help with the business structuring, make sure everyone is protecting their assets, make sure that they're in compliance. And then my partners kind of help put it all together once we protect everything as far as what is the best way for us to put more money in our pocket and to really maximize our tax liability at the end of the year. Once our clients are established and we have a proper formation and tax strategy in place, we then will look at asset protection, as you mentioned, and the different options we have when it comes to protecting our assets. We'll get into that towards the end, but as many know, a revocable living trust is very important to avoid any sort of probate, court. Make sure that everything goes to your beneficiaries, your spouse, children, grandchildren upon passing. But the problem is there's just no protection, asset protection in a revocable living trust. So there's some alternative entities and structures that we can help our clients, that we do help our clients put in place to make sure that they're protecting the assets that need to be protected and they're running their businesses properly. I've been at it since 2005. I've been lucky enough to be in one industry pretty much my whole career. Started off, worked my way up as a general manager with a company, and in 2013 decided to take that risk, as many of us have, and set up my own company here in Las Vegas. As I mentioned, we do specialize in three areas: corporate structuring, accounting and tax, and then asset protection. If it's okay, I'm going to jump right into the LLCs and the corporate structures that we offer our clients. I'm a big believer in working hard. I'm a big believer in playing hard. I'm a big believer in, we live in a country that offers a lot of opportunity, whether it's for growth, whether it's liability. Unfortunately, we live in a country where a lot of people, their mentality is the fastest way to get rich is either winning a lawsuit or winning the lottery. So a lot of times when you're business owners, when you're investors, you have properties, rentals, you own business such as myself, Mark, you're putting yourself in a position where you potentially have a target on your back. So from day one, when I got into this industry, I did my own research on what is the best state to incorporate in. Just because we run a business in California or we have a property in Florida doesn't mean we have to incorporate or set up our headquarters or our structure in the state we live in or where that asset is in. In many cases, most of our clients, and I've been involved with 13,000 plus corporations and LLCs since 2005. And I can literally tell you 99.9% of those entities have either been set up in Wyoming or Nevada. Now, my business that we own, our building here is in Las Vegas, Nevada. We do just as many Wyoming, if not more, now than we do in our own state because of the protection that those states offer that you just simply don't get in states where you potentially live or have these investments in. For example, in Nevada and in Wyoming, if an entity were to be sued, they have very strong language and very strong statutes that protect the owner. So there's charging order protection, which protects the ownership and the interest of the entity. Because there's no state income tax or corporate tax or any type of franchise tax like you have in Delaware or California, you're not paying any additional tax in that state. You're just simply structuring yourself and these assets in a state that if something were to happen, for example, I run a day-to-day business where we help set up LLCs and corporations, we file tax returns. If something happens and my business ever gets sued, corporate capital could potentially be liable or brought into some type of litigation, but they can never go after Brent Carlson or Josh or the Caps, my other partners, because we are in a business-friendly state. So again, because there's no taxes in Nevada and Wyoming, we typically will headquarter our clients there and then foreign file them and register them to do business where they live or where they're running a day-to-day operation or where they have some rental properties or they're doing some fix and flips, because it does not put any more strain or burden on the financial part of things. It just gives you that separation. And I've always used the same analogy. It's like a brick wall between your business life and your personal life. And by having the headquarters in either Nevada or Wyoming, you're putting yourself in a position where you personally are keeping yourself separate from the business and from that investment, and they cannot come after and sue you personally. And again,
Question. I have a question on that, Brett. I'm sorry to cut
yeah,
you off. You
no
said
problem.
something about charging order protection. For people listening, what is charging order protection? Why don't you talk a little bit about that? Because this is really key.
Yeah, so like when you have assets in your business and you lose a lawsuit, some potentially they can just get a charging order, which means they can't force you to sell the asset in the business. And at the end of the year, they may get a K1 that shows that they won a $50,000 lawsuit, but the business didn't have the money to pay that. So they get this. So the charging order kicks in. So they can't force you to liquidate or do certain things with the business. So therefore, a lot of times the lawsuit will get dropped, or they might not pursue it any further, depending on the nature of the business and who's representing the other side. So the charging order protection really helps protect the assets. Even though the business may have done something wrong, the charging order can kick in and make it to where you're not liquidating or getting rid of any asset to satisfy that judgment. The most important part of the charging order protection, especially in a business like mine, is I have partners. So with having partners, if someone goes out and does something on the weekends, it's Monday, so you may have had a long weekend. You may go to church on Sundays. You may go to a ball game on Sunday. If something happens in your personal life and you get sued, that charging order kicks in. So where they can't take the interest and the ownership of the company. So me having two partners with corporate capital, if something happens and Josh goes out and does something silly, I don't have to worry about someone being able to sue him and take the ownership or the interest of an LLC or the stock of the corporation, because the state does not allow that. And so the charging order protection is just such a powerful tool. A lot of states will offer some sort of charging order protection, but again, the only states that don't allow the corporate veil to be penetrated typically are the Nevadas, the Wyoming, and the Delaware. Now, we don't do a lot of Delaware unless you're looking to be publicly traded, because there's a little bit of a franchise tax and there's some additional fees that you can avoid by skipping out on that state. So if you're more of a private business and private investors, which most of our clients are, we'll do Nevada and Wyoming because of that charging order protection. I give examples a lot of time of different states. Behind me, you can see my jersey. I played college football at BYU in Utah. Utah is very friendly state, a lot of friendly people, but they have very goofy rules when it comes to piercing the corporate veil. If you are commingling funds, even if it's on accident and you use business expenses for personal or vice versa, the corporate veil can be pierced because you commingled funds. So unless you're committing fraud with the intent to commit fraud, states like Nevada and Wyoming will not allow you as the owner or the organizer of that company or the president of that corporation to be sued personally in the event that something happens. So that's why we headquarter our clients there. And again, to be very transparent, especially states like California, they expect their tax. They have a franchise tax fee. So I tell my clients, in most cases, you're still going to have to pay the franchise tax where you live. You're still going to have some taxes that you're going to have to pay because you're in one of those states and the asset is in that state. There's no way around that. So because there's no way around that in a lot of cases, I always structure my clients in Nevada or Wyoming, because after it's set up, all you have to do each year is simply renew with the Secretary of State, where you're talking between maybe $300-500 additional to have your company headquartered in the most business-friendly state in the union. And then ultimately, you're going to be registered to do business where that property is. If you have rentals, register there, because if a rental, tenant slips and falls, finds mold, you want to make sure that you are protected and you're in compliance. So again, in most cases, we'll have those LLCs registered where you live or where the assets are, but they will not have the ability to come after you personally. And it does not cost you anything additional. And it's not like you're being double taxed. You're not paying a tax to Wyoming. You're not paying a tax to Nevada. You're just simply paying a tax. And a lot of cases with the LLC, it's flowing to your personal return anyhow. So you're paying that on your Schedule C. And then as we get into the more of the taxes, the LLC has just different ways that you can be taxed. And I'm going to go over that because most of our clients end up doing alternative tax methods with their structure once it's formed. When I first started back in 2005, we set up a lot of corporations. That changed in 2008, 2009, because LLCs have the ability to be taxed however you want. So a lot of you may be a sole proprietor out there. So a sole proprietorship and a single member LLC, there's really not a lot of difference with those when it comes to your taxes. The difference is now
Right.
that, yes,
I got a I got a question before we jump into taxes. I want to go
yeah,
back to the LLC for a second
yeah,
here, because you said something about being registered in one of the Wyoming, Nevada, but then you're saying registered within your state. You want to clarify something because I've heard a couple different things.
sure.
Should you create another LLC within that state and have your Wyoming be the owner, or is that Wyoming a foreign entity in that state? How do you recommend that?
That is a great question, Mark, because there's really no cookie cutter approach to that where it's just a simple answer. Because in a lot of cases, we'll take that Wyoming or Nevada entity and we'll foreign file it to do business in California. And I'll use California as an example, Pennsylvania, wherever. So you'll register to do business in that state. So you'll have one entity. Now, depending on your structure and the assets you have, and the state that you live in as far as taxes, there are some benefits to potentially having a holding company in Nevada or Wyoming that owns that entity, depending on how we can have it work in conjunction with that business. Because if we can potentially get some money out of one of those states that has a very high tax, then we want to look at that. But again, a lot of states put a block on that, even with a holding company. So again, it depends on the industry that you're in. It depends on the assets that you have. But most of our clients will have their main entity foreign filed to do business where they live. But I do have a handful of clients, because they have very advanced structure, a lot of assets. Well, they will form a company in Nevada or Wyoming. Still, Mark, to answer your question, instead of having a California LLC, I really never want my clients to have California at all. I don't want them to have Hawaii, even though Hawaii is very laid back. Some of the greatest people, greatest food. There's a lot of litigation there, so there's a lot of liability. So instead of even forming the actual operating entity in that state, what I will do is I'll have two entities. In this case, I'll have one in Wyoming that stays headquartered there and never leaves. It's its permanent home, has a bank account, has an address. Then we'll have another Wyoming LLC that is managed or owned by that holding company, and that Wyoming LLC would then be registered to do business in California. I never want the statutes or the articles or the bylaws to come from one of those states that allow the corporate veil to be pierced. So even in that example, I would still potentially have two entities in either Nevada or Wyoming, with one of them registered to do business in that state, as opposed to having a California LLC that is managed or owned by the Wyoming company. I like to give another layer of protection and just have that operating entity still in one of those more business friendly states, but register to do business in a state like California. Does that make sense?
It does. Now, what if because everybody's listening, and most likely they're into real estate. You also don't wanna have all your assets and properties in one LLC as well. Is that correct? Just in case if something happens?
That is absolutely correct. You know the saying, the analogy, never put more than one egg in a basket, or all your eggs in one basket. It's very, very true. Because whatever is inside of that basket or inside of that LLC is potentially at risk. So if you have real estate and the investments aren't, the most expensive, maybe you have a couple of units, 30, 40, $50,000, then we will have clients that will put maybe two or three underneath one LLC. But if you're talking decent equity, $1 million property, $500,000 property, I still believe in investing in having the expense and having those entities and those assets separated. But again, we'll look at the portfolio and give the recommendation based off of what the asset looks like and the potential liability. Now, in states like California, Nevada, Texas, there's around 19 states that have and recognize what's known as a series LLC. Now, with my company, obviously, we make a living off of forming LLC. So I have a client in Wyoming who has 64 LLCs for his properties between here and the state of Wyoming. I have another guy here in Las Vegas that has 33 properties, and they're all underneath one series LLC. So now the nice thing about a series LLC is you can form one company, and now you have Series A for property that's located on Rainbow Boulevard. You have Series B for the property on West Sahara. You have Series C for the property down on the Strip. So you can separate those properties and those assets individually within a series LLC. And the beautiful thing about that is now you only have one renewal with the state. For example, here in Nevada, it's $350 a year to renew an LLC. So if you had to do that times 64, I mean, it starts getting really expensive to renew these companies on a year in and year out basis. Now, if your portfolio supports that and you want to have that absolute separation, then you can certainly do it that way. But the states that recognize the series LLC, as long as it's done correctly, which we help our clients with the articles, the EIN, we help with the operating agreement, we help with all the different series or cells of this LLC. So now if something happens on property, 3 or in series 3, they can't go after series 1, 2, 4 through 10. It's just like having your own separate LLC. So if you're in a state that allows series LLCs and you have multiple properties, that's where, a consultation will come into play. One thing I did tell Mark that I would be more than happy to offer, my partners and I, we set up a dedicated, phone number for this group to go over your specific situation, to see what state you're in, if a series LLC would benefit you, or if it's even allowed to be used. But ultimately, we want to keep your structure as simple as possible while it's so advanced that it can protect each asset that you have. And the series LLC, again, can also be taxed. Now, one thing is we got to keep similar businesses in there. So if you're using it for real estate, for the most part, series LLCs would be used for real estate purposes for investors that have multiple properties. If you're in a state that does not allow series LLCs, then you absolutely would want to have an LLC for each asset, because you're truly separating the liability. So if something does happen, now they can't go after, the additional properties that you have. And then more importantly, going back to the biggest thing for me as a successful business owner is not being personally held responsible in the event something hits the fan, and having that separation. So it's important to make sure that you separate the assets. There's a few things that you can do where you can have a few LLCs if you're not in a state that recognizes series LLCs, where we can use a few LLCs. Then we could potentially use an asset protection trust, which I'll get into towards the end of the conversation, which is another option that you have to kind of keep those costs down, not have to set up so many different LLCs. But ultimately, going back to Mark's point, if you had 10 properties in one LLC, and I'm a big football guy. My heart broke. I'm a father of 4 boys. I saw that one of the Tampa Bay Buccaneers had a 2-year-old, unfortunately, drowned this weekend, and just very sad. Kind of makes you reflect, and it's one of those things where what can we do to make sure that we're doing everything we can to protect ourselves, protect the people around us. And it's just important to make sure that you have those things in place, because you never know what's going to take place. I had a client that found such bad black mold in their home that they almost lost everything. And if it wasn't for some of the structure that we had put in place years prior, it would have really gotten ugly. And I truly believe to this day they would have lost everything. But instead, because they were proactive, they put the structure in place. There's different ways that you can separate that liability and just make sure that your insurance kicks in. I always recommend having some general liability insurance. It really isn't that expensive, and let that insurance do its job. Have an umbrella policy, but then make sure that is all they could potentially go after, and never you as that investor or as that owner.
Good stuff. Yeah, it's highly, highly recommend all that. So, all right, so let's I think we talked a lot about the LLC. That was great stuff. Let's kind of dive into what taxes.
Yeah, well, and the LLC, one thing that the reason we do so many of them is it's a lot easier to run and maintain, and the LLC offers the flexibility to be taxed however you want. So it can be taxed as a single member, where it still flows down to you on your Schedule C. It can be taxed as an S corporation, which my main business is taxed as an S corporation. I also have an LLC that's taxed as a C corporation, because we use that for different purposes or investments. So the LLC has the flexibility to be taxed just like a corporation, and in many cases, because it's cheaper to renew in a lot of most states, and because it's a lot easier to run and maintain year in and year out, unlike a corporation, we will typically recommend and set up the LLC and then have it taxed in your best interest. Now, many people will have a single member LLC when they come to us, and we'll look at that and evaluate what is actually the best way for them to be taxed. An S corporation is able to bypass some of that self-employment tax. So the 15.3% that we pay on our W-2, for Social Security, Medicare, Medicaid, there's no way around that when you're a single member LLC or when you're a sole proprietorship. So you're paying that 15.3% on all the money that you're making. So what we do with our clients in many cases, depending on the gross revenue for their business or the money they're bringing in for their investments, we'll look to see the best way for them to be taxed. In most cases, the S corporation makes the most sense, because now we're able to pay ourselves a reasonable salary. At the end of the year, for example, if my business, let's say we have, just throwing out numbers, a few $100,000 profit at the end of the year, each partner will get a K1 because we're an S corporation. So now the IRS is going to be notified that corporate capital has a $300,000 profit, again, just using examples, and each partner is going to get that $100,000 K1. Well, instead of me having to pay my ordinary tax bracket, let's say 24% or whatever the number is, and the 15.3%, you're only paying the tax on the tax bracket that you're in now with that distribution and that K1 at the end of the year. So in many cases, we're able to show our clients every $100,000 of profit that you're making, you're able to save $15,000 by just having your business taxed separate than a sole proprietorship or a single member. Now, if it doesn't make sense, again, we look at every situation and go through it very thoroughly to make sure it makes sense, because there's some obligations that come with an S corporation. For example, you have to pay yourself, salaries, so you have payroll. There's different things that you have to do along those lines. So we want to make sure it makes sense for you and that you're going to save the amount of money to exceed any other time and expenses that you're going to have by being an S corporation. But in many cases, that is what makes the most sense for our clients who have a decent annual income and profits at the end of the year. Now, what I really get excited about is S corporation is great. Saving the 15.3% is great, but as a business owner and as a father of 4 kids, there's so many things that we can do through our businesses when it comes to tax strategies and tax planning. For example, and if any of you have spent any time on social media, especially during tax season, you saw a lot of things come up about paying your kids or the Augusta rule. And those are 2 things that we do, ourselves, that I take advantage of as an owner. I have 4 boys, so each year I will pay my boys. I'll have them do something for my company, and I'll pay them enough to keep them under the threshold of having to file a tax return with the IRS. And last year it was 12,800, I believe. This year is 13,700. So unless your kids are being paid more than 13,700, they don't have to file a tax return with the federal government. Now, the company, Corporate Capital, will use my company again as an example. Let's say with 4 kids getting paid 13 grand, that's a $52,000 deduction for my business that ultimately is going to my kids. So now my kids are employees. So now I can set up 401ks for them, which I've done. My 7-year-old has money in his 401k, right? So now as he builds compound interest on that, he's going to be in a pretty good position. And my company was able to benefit from a write-off. So we always look at that. Are there ways that you can really lower your tax burden before the end of the year? Because once December 31st comes and goes, there's not a lot we can do. A lot of people will come to me and ask, well, can I go back and pay my kids or do the Augusta rule? It's really hard because there's no paper trail. There's no checks that were cashed. So we try to get our hands on our clients now, like second quarter, third quarter, to really start looking to see the revenue they're bringing in. Does it make sense to pay the kids? Do they have children under 18? And you could pay them even older than that. But again, a lot of times when they're older than 18 or so, then they're making that more than that threshold and filing their tax return. So a lot of times we're doing this to minimize our tax liability as owners while benefiting from it. So for example, my 15-year-old who has been paid for the last couple of years, has money in his account, and I won't share how much, but a lot of people would be really surprised how much we've been able to put aside. And now when he turns 16 in July, he has the money in the account to buy the car. So now basically he's buying his own vehicle. So now instead of that money going through Brent Carlson and me paying taxes on it, he worked for the company. We had an employment agreement with him. I paid him, and now he's able to pay for some of those things on his own. Obviously, I'm helping him manage that as his dad, but I'm reaping the benefit. My 7-year-old, over the summer, we put him in a private school. It's called Challenger here in Las Vegas. We put him in that just for a little bit more education so he doesn't lose so much over the summer. So we actually take the money that we're paying him and have him with his account pay for some of those things. Again, just reaping the benefits where I'm not paying for these things after I'm taxed. I'm getting a write-off for my business, paying them direct, and then they're covering some of those things in their personal life, whether it's buying a car or the education over the summer or Little League. They can pay for some of those things on their own, regardless of their age. So we help our clients with all of those employment agreements. We help them with all the paperwork that comes with it, because you don't want to just write your kid a check and then say, I'll deal with it later. You want to make sure that you have those agreements in place and that you're doing it the correct way. Because if you do ever get audited, you want to be able to show that, hey, I have this employment agreement. They signed it. This is what they're doing. These are their job duties. So we have that for our children. Our clients who we help with this and implement this, we help them with some of that paperwork as well, just to make sure it's being done correctly. This isn't something that is being done to try to disguise or hide income or anything. It's low-hanging fruit is what I like to call it. The IRS shows you different ways that you can tax plan and things you can do as an owner, and that's one of them. So I really encourage you, if you have children and you have businesses, you have LLCs already in place, maybe jump on a quick call I'm happy to include my partners on some of those calls, do a consultation to say, yes, you can start paying your children this year based off of X, Y, and Z. The other thing, Mark, okay if I get into the next tax planning strategy, or do you have any comments about that?
That's good. But what's the phone number if anybody's listening right now where they can call you on? I think it's right there on the
Yes,
screen.
it's 855-767-1977. So again, 855-767-1977. Just so you know, I told Mark that his students and this following is his reputation. Obviously, corporate capital has its reputation as well. It's important that we follow through and commit to his group. And so when you call that number, you'll get myself, you'll get Jamie Cap, who's one of the owners, you'll get Flo, who's one of our founders, or you'll get my assistant. And those are pretty much the main people that will take these calls to provide these consultations. So that number will be dedicated to ring to those 4 people. And I will be one of those that will answer some of those direct, take those calls and answer any questions that you have. The second thing that's really exciting to me that a lot of people don't take advantage of, and I encourage you to do some research, but the Augusta rule. If you're a golfer like me, you see some of this golf back here, love golf. Augusta, Georgia is where they have the Masters each year. And I'll tell you what, if you're not taking advantage of the Augusta rule, and you can, you're really missing the boat. The Augusta rule, basically 14 times a year, you can have a meeting, and that meeting can be at your home. Whether you rent or you own, that meeting can be anywhere that you'd like it to be. So what our company does is we put together the comps. So we'll call Baltimore, Maryland. We have all the comps here in Las Vegas for like the Wynn, the Convention Center, the Bellagio, places in New York, Cromwell, places of that nature, right? So instead of going and spending a day at one of those facilities, again, it's kind of the craziest tax planning strategy and a low-hanging fruit that I call it with the IRS. You can have that meeting at your home, and you can actually compensate yourself 14 times a year for that meeting. So instead of you actually going to the Bellagio and spending $2,000 for their room for the day, you can now have that meeting at your home, which again, it just makes me laugh because a lot of homes aren't as nice as the Bellagio, room and not the same amenities and things of that nature. However, you're able to do and take advantage of this Augusta rule. So 14 times a year, you can pay yourself. And in most cases, the research on average is about $2,000 per meeting. So that's a $28,000 deduction. And if you use, again, just my company as an example, because I think that's the best way to do it. If there's 3 partners and you're doing that for each partner, that's a $4,000 tax deduction, which is dollar for dollar for the business, which now goes back to you as the owner that's providing the meeting at your home. Now you get to write that check from your business to you personally, deposit in your personal account. The best part about it, you do not claim it as income. There is 0 income that is reported on the Augusta rule. So now your business gets this deduction dollar for dollar. The money goes back into your personal bank account, and you're not paying any taxes on it. So again, the only requirement, though, is you truly have to show that there's meetings taking place. So we'll help our clients with those meetings. We'll make sure that they're, jotting down what they talked about and making sure that it's being done properly, where there's a date and a time and the discussions that took place. Because again, if there's ever any type of audit, you want to make sure that you're prepared for it. And there's no reason to go back and scramble, because this doesn't take a lot of time to have these agreements in place to pay your kids, or to have these agreements in place to have the meeting at your home and still get, like I said, some massive tax deductions for your entities while that money goes back into you or potentially your kids' pockets. So those are just a couple examples. If you're starting to get to the point where you're paying $75,000, $100,000 a year in taxes, then there's some more advanced tax planning strategies that can be, discussed, like captive insurance and different things. Not a conversation for this call, but if you're in that situation, again, I would recommend, giving us a quick call to go over that and to get you on the phone with someone. And again, that number is 855-767-1977. But if you're starting to pay those types of taxes on a personal level, it's really important that you look at all your alternatives, because there are several of them out there. And as a business owner, I will tell you, so much new business that comes from us, a lot of accounting firms, they're so busy that all they do is take the numbers that you're providing, they're plugging them in, and they're spitting out a tax return. And they're doing that for a couple reasons, because first off, you're coming to them in March or April of the tax year for the previous year, so there's nothing that can be done, or they just don't know about it. But I have found that a lot of people, unless it's their own pocketbook and their own wallet, they just don't spend the time educating the clients. They can still charge the same amount for the tax return. And until they hear about this and see how much they're missing out on, people, you don't know what you don't know. An example, I had a podiatrist in Arizona, doctor, paid $800,000 a year prior to coming to us. And then his tax liability got cut in half because of these strategies and the things we were able to implement. He was so mad, and he had been with the same CPA for, I think, 12 years. He was so upset. He had 5 kids. He qualified for the Augusta, just things that were never brought up to him. So once we implemented the first year, it literally cut it in half. And to see that excitement and to see that progression, that's what I enjoy as a business owner, because ultimately, the more that you put back in your pocket, the more you have your portfolio, and everyone wins. Because the more you grow, the more LLCs you're going to possibly need, the more accounting advice, and then ultimately the asset protection strategies, the trust that we'll discuss next. Any questions about that, Mark, or any other thing on taxes?
No, I think it's great. I'm learning some stuff right now as we're live on this stuff. I'm not even aware of some of this stuff, and I'm a pretty intelligent dude, but the tax code in general is just so complicated. It's like but I'm glad that we have you on here and you're kind of educating on those stuff. So that's great. So definitely let's
Well,
talk a little bit about the asset protection as well.
well, one thing too I want to point out, and if you're not doing this, do this now, even if we don't hear from you. Put it on your calendar every quarter to reach out to your CPA or your accountant. Every single quarter, like clockwork, I am on my business partner, Josh McLean. Our website, by the way, is corpcapinc.com. So that's www.corpcapinc.com. So corpcapinc.com. We have everything on there, from our services to our Meet the Team page. So my partner, Josh McLean, our head CPA, every single quarter I'm on the calendar, and we sit down and we look at, like I just had my partner today, May 1st, send over the comparisons from April 2022 to April 2023, and then year to date, right? From January 1st, 2022 to the end of April 2022 to January 1st, 2023 to the end of April, just to see how we're comparing. We've been very blessed and fortunate that each year, we seem to get more clients, and that continues to go up. So as owners, we're constantly looking, what else can we do to strategize? What should our estimated tax payment be? Last month I sent off a dollar amount to the IRS because I thought, okay, we continue to project like this based off the last 10 years of experience and financials. This is what I'm looking at the end of the year. So we look at estimated tax payments. We look at alternative tax planning. So I recommend strongly to get with your CPA or accountant for the first quarter to see how the projections are looking, to see if there's an estimated payment that should be made, and then to start asking those questions. Do I qualify for some of these tax planning strategies? If they tell you no, give me a call personally, and I'll look it over with my partner quickly to say, you know what, he's exactly right. And we're not afraid to do that. If there's ever a time where your person's doing a great job, I think there's plenty of business to go around. I think if you have a good doctor, you have a good mechanic, you have a good, real estate agent, whatever you're doing, stick with that person. However, it's not a bad idea to get a second opinion and a second set of eyes. So If you get told no and you feel like, I feel like there's a possibility that I could be doing more here, then reach out and we'll let you know. But if they're doing a good job, we're not afraid to tell you that as well. But at least you'll have the peace of mind of knowing that you're doing everything you can when it comes to your taxes and put money in your
Yeah,
pocket.
that's huge. It's like, yeah, it's huge because some people don't even want to call their CPA because they're going to get it just for a 5-minute phone call, getting $150 bill, like with some of their CPAs.
Hey, I got to tell you, I take pride in this. It's our business. It's worked for us. Any client that we set up an LLC for, any client that we do taxes for, any client that we set up a trust for, we never bill them by the hour. So if I give you a fee to do your taxes, whether it's a personal return, a business return, a trust return, that is a one-time fee. So a lot of my new clients that come to us for 2023, what I typically do is I'll just say, this is our fee to do the taxes for a business return and what your portfolio looks like. So whether you sign up today or you sign up next March, I'm still going to charge you the same amount of money. The difference is once you're a client of ours, you can call and ask questions anytime. We never bill you by the hour. We'll send you emails. We'll put it all in writing. If you're a client, you're a client. And by doing this, we've got a lot of referrals. We have a lot of relationships like with people like Mark, because we go out of our way to make sure that they're being serviced. If you service your client, the more you talk to them, the more relationship you have, the more referrals that you're going to get. So yeah, with us, whether we form the LLC or the tax preparation, you're able to contact us at any point in time. When I first started my business, I know exactly what Mark's talking about. I was afraid to send an email because every time they emailed back and said, yes, comma, that's correct, I would get billed a 15-minute increment, right? And it just would tick me off because it literally probably took them 15 seconds to read my email and 2 seconds to actually respond. And I'm paying, $75 or whatever that hourly rate was divided by 4. So I think it's important to, if you're going to offer a service, offer a service. We don't want any gray area. The communication is important because, again, the more you grow, the more we grow. So you don't ever have to worry about any of those hourly fees. So thanks for bringing that up, Mark. I appreciate that.
That's huge. That's really huge. Because I hear a lot of people complain about that. It's like, but thank you.
Yeah. And the two other things I'd like to talk about today is the trust. As I mentioned earlier, revocable living trust. When I set up my business from day one, I had a living trust, which was called For My Boys Living Trust because I have 4 boys. So I didn't go with the Carlson family trust. A lot of people just use their last name. I wanted to have fun with it. So I called it the, For My Boys Living Trust. So my personal residence is in there, my personal bank account, and that's it. Everything else that I have, from commercial property to the interest of my business, is actually issued and assigned to an asset protection trust. So an asset protection trust is a unique irrevocable trust, and there's only a few states that offer the Nevada or the irrevocable trust with revocable privileges. Because a lot of times when you form an irrevocable trust, you really can't get things out of it. It's like a black hole. So once you transfer the assets in there, they're pretty much stuck there forever until that grantor passes and the beneficiary kicks in. The very unique thing about the Nevada Asset Protection Trust is it's a trust that you can put your property directly in. You can put cash in there. You can put guns in there. The stock of my company, the interest of our businesses, for my partners and I, for one of our, let's say MJ Audit, that stock is issued directly inside the asset protection trust. So we do that for a couple of reasons. Now we're keeping the interest and the stock out of our name personally. Anything that's inside of this trust is protected after a 2-year period. So you do have a 2-year look back period. So it's always important to start that clock as soon as possible. But any asset that gets transferred in there, whether it's interest of a company, whether it's real property, land, whether it's those other things I mentioned, as soon as they're transferred in, that 2 years starts. So now after 2 years, if you were to get sued, anything that's inside of that trust is basically protected. I like to use the word bulletproof. Obviously, courts and judges, there's been some goofy things that have taken place over the history of time. But in my 20 years experience, those assets that are in there after that 2-year look back period are protected from creditors, litigation, third parties. So we have our clients, and that's why I mentioned earlier, you may not have to set up LLCs for every property. You may have some properties in some LLCs, depending on what state, and you may have some property directly inside of the asset protection trust. What's nice is when you go to sell the business or you go to sell the property, you can transfer it back out into an entity. You can transfer it back out into the individual's name and then sell it that way. Because obviously a trust will pay a higher tax in most cases than an individual or a corporation. So we don't want to necessarily have the sell or that transaction take place and stay in the trust if we're going to be paying 10, 15% more, but we sure as hell want to protect our assets the best we can until that day comes, and we'll utilize the trust for that purpose. Now, there's two things that you can't change inside of a asset protection trust, and that's the grantor, which why would you want to change the grantor? The grantor is the one who put it together in the first place. And then the other thing you can't change is the beneficiary. So what we do is we make the beneficiary of your asset protection trust, of your irrevocable trust, your revocable living trust. So again, until you pass as the grantor, or you and your wife or you and your husband pass as the grantor, that's when the beneficiary ultimately is going to kick in. Now, what's nice about that is now you have all your businesses, you have these properties, you have the money, gun, everything inside this asset protection trust. Both grantors or one grantor passes, it goes to the beneficiary. The beneficiary is the revocable living trust, which it's revocable. So now you can put and make any changes you want to that trust. I use my client in Arizona a lot as an example. Multi-millionaire, he's in his 90s. He's old school. He's about work ethic. He's about, doing things the right way. So he actually is leaving his assets to just a few of his grandchildren, and he's actually disinheriting more than who are actually receiving assets. Same thing with some of his children. He has made changes because of some of the challenges they've had in their personal life, and in some cases, some of their successes. So he's actually taken them out and disinherited them and made it to where those assets are going to specific beneficiaries. So ultimately, you can make as many changes as you want to that revocable living trust. And then when that revocable living trust needs to do its job, because you as the grantor of this entire structure, your businesses, the asset protection trust, the living trust, ultimately everything will flow down to and that is where you'll avoid probate court. And that's where you won't have to worry about hiring a probate attorney. Hiring a probate attorney and the retainer is more expensive than just setting up both of these trusts from the beginning. My cousin in Washington just had his mom and dad both pass away in their home about a month ago now. And he has a property, it's worth like 270. He's got like $50,000 in equity. That's all they have. The cheapest he could find for a probate attorney was $10,000 was the retainer he had to give for one asset. You could have set up both trusts for less than that and had not worried about any of it. Now, again, the problem with the revocable living trust is there's no protection in that trust. So anything that's inside of there can actually be penetrated or forced out in the event of a lawsuit. So that's why we want to have both pieces in place. Now, a lot of you, and this really bothers me when it comes to advertising and what people are trying to do for their families versus what they are actually doing. And what I mean by that is a will. So a lot of people will have a will, but the problem with the will is it will go through probate court. And a lot of people don't know that. A lot of people think if I have a will, everything's going to go to my family, my beneficiaries. Here, let me close this for you guys. The sun's starting to get there. So you might have a will in place, and those beneficiaries are going to be ultimately receiving those assets, but that's after your entire estate goes through probate. So like the businesses, your residence, your bank, whatever you have inside of or listed in your name, obviously will go to those beneficiaries, but a will always go through probate court. So your revocable living trust, and the reason why it's so important to have a living trust is now your power of attorney, your healthcare, your any financial decisions, your will, all of that is part of your living trust. So now those assets that are inside of the trust, the will disperse those to the beneficiary the proper way. And that is why it's so important, because a lot of people, when they come to me, they don't have anything in place, to be very candid, regardless of their age. But when they do, they're like, yeah, I have a will. And then when I tell them the story about a will and the protection or lack thereof that they have, then they realize, well, this is really not what I wanted. I wanted to make sure that my family avoided probate court. But the problem with a lot of that stuff is when you avoid probate court, um, you're paying your sorry, just one second.
And
Um,
afterwards, we got a question afterwards, but
Oh, no problem. So when you have the probate court, you're having to, like I said, you're having to pay the attorney. You have to have the assets listed in the trust. So the problem I have with the will is a lot of attorneys will advertise, set up a will for $99 or $499, right? And then when something happens and the dad or grandpa passes, then typically the family will go back to the attorney who drew up the will, and that's their payday, right? Now they're getting this retainer to help you through probate court. A lot of times it's minimum 10 grand, 10, 15, $20,000. That is where they really make their money, as opposed to just doing a living trust from the beginning. So I have a lot more respect for the attorneys that advertise the living trust on TV as opposed to just the living wills, because the will always go through probate and still cause your spouse in some cases, and definitely your children and grandchildren, a delay process. And when COVID was around, that was 12 to 18 months sometimes the probate process was taking. So now imagine if you passed and your spouse, your kids relied on that income or needed access to the bank account, and they didn't have it and they had to wait 12 to 18 months. There's some families that would really, really destroy them, and they could just all be bypassed and streamlined by simply having that trust in place. Yes, Mark.
it's great stuff. Um, all this was phenomenal. Brian's got a question here. Let's see here. Do you give advice on where our dollars and assets should be put in an LLC, trust, etc.?
Absolutely. Yeah, no, we're not just forming this and sending it and then having you kind of do it on your own. That's really where the work begins. Once we have everything in place, we'll look at the entire portfolio. We'll go through exactly what you have, the assets you have, the businesses you have, and then in many cases, I work with my partners and attorney to go through and send you a very detailed email, so you have it in writing, so you have it to reference. So we always can go back and say, this is what we wanted to do from day one, and these are the goals that set out in front of you. But that's exactly what we do, and that's why we offer the ongoing consulting for our clients, to make sure that if they ever have questions, if they are trying to move money around, they're selling assets. That's exactly what we do. The work begins after we get everything set up to make sure that it's being utilized properly.
Yeah, I was talking to a friend of mine. He was, we bike ride in the morning. He was sitting there talking about his CPA, and he's like, you know, my CPA is like, we had a conversation, and he didn't remember anything, and he didn't remember what kind of entity or anything I'm set up. I'm like, he doesn't have a CRM. He can't keep track of what is going on in the conversations. I was just blown away when when he told me that.
My partner Josh, who handles my entire portfolio, and I should be careful to make sure he doesn't hear how good I talk about him, but he is just phenomenal when it comes to his organization. I mean, every time he's on the phone with a client, he is typing out an outline, with exactly what they have, how it's taxed, what state they're in, kids' names, very, very, very detailed, because obviously that's how you're going to get the most benefit. And then there's nothing more frustrating than having to repeat yourself and going over, the same thing over and over, because that's a waste of everyone's time. But ultimately, if they don't understand your situation and they're asking the same questions, then they're just going through the motions, right? And then they're just, at that point, you're really not benefiting. So whoever that's happening to, yeah, let's definitely get them on the call and take a look at what's going on.
Yeah, absolutely. All right. So we have, what if you have a college age student? And I'm trying to understand, you can still pay the child.
Yeah, so in many cases with the college age student, they're depending on where you're at, you can still pay them because they can still be an employee, unless they make more than the 13.7. You're not, they're not paying taxes. So it's just like any other employee at that point in time. But a lot of times, when they're that age, it's hard for you to pay them the max. As the example, because let's say you pay them 13.7, and then they have a side job where they're working a Jamba Juice or the gym a couple days a week, then they would obviously have to file their taxes. So depending on what they are making, if anything, you can pay whoever you want, any employee you want, and unless they exceed that threshold, then they don't have to file taxes, and your business is still getting the write off. So in some cases like that, and again, this would be a conversation where it's more one on one. But we may have you set up an additional LLC where you send the money from your business to the additional LLC, talking about layers earlier, Mark, and then have that LLC potentially pay that child.
And that user saying that they're in Arizona, by the way.
Okay.
Okay. All right.
Yeah,
So,
I love it. This is a great setup.
all right. So Brian's asking another question here. Can you read that? That is a great, was
Yeah,
a lot of
a lot
people
of people
don't
don't
think
think about this.
about.
He said, I'm new to real estate, but would love to set it up right way from the beginning. Also, the income tax stuff because I'm from New York, where it kills me here. Yeah, and that's something where you always want to look at, and that's where we're very transparent, because states like New York and California, even though your investments may be elsewhere, especially California, they're like, nope, everything should be paid here. You should be paying the franchise tax here. You should be paying all your taxes here. So we'll look at that to see what you can and can't do. And we'll be very transparent to say there are ways that you can avoid, maybe paying a tax like that because you're in such a highly taxed state. That's one thing I do love about Nevada. Now, our sales tax is a little bit higher than other states. That's where they make up for it. But, the fact we have no income tax, no corporate tax, it really does benefit us. And it benefits some of our clients depending on what they're doing and what type of business they're in.
Oh, this is awesome. I think this was phenomenal, and everybody's going to be listening to this. If you're listening to this on your podcast or YouTube, once again, the phone number to reach out to them is 855 767 1977. 855-767-1977. So I think this was great. Thanks so much for coming on, especially at this late at night. Oh, we had a couple more comments here. Let's see what somebody's asking.
And also, while you're pulling it up,
Okay.
we have an email as well dedicated. So just info@corpcapinc.com. I gave the website earlier. So info @corpcapinc, CORPCAPINC.com. You can send an email, and I'll know that came over from this group. And so the consultation and just getting on a call, we can do it that way, or you can just call in direct.
Yeah, because you mentioned everybody that's coming across, you're doing a consultation for free for everybody, and that's, helping everybody out, so I really appreciate that.
Yep.
So,
Yeah, and
all right,
I mean this as an owner, because I don't like going somewhere and feeling pressure whether I'm buying a car or doing anything else in life. So it truly is just a relationship, a commitment that I made to Mark, because he has been wonderful to work with. He's referred over some great clients that we're working with today, and it's just it truly is a win-win. So don't feel like you have to do anything with our firm. If you have questions, just call, get those answers, and ultimately we'll see if there's a natural fit and relationship there. But we'll at least give you the direction and guidance you need to know that you're making an educated decision and doing everything you can for you and your family and your portfolio.
right, appreciate it.
Thank
Anybody
you.
listening, please share this, like us, and, please leave a comment with one of your favorite podcasts. So, thank you guys for listening. Brent, you can stay on while we just disconnect the podcast. Thanks, everybody,
All
for,
right.
joining us this evening. Take care.
Thanks, Mark. Thanks, audience. Appreciate it. Look forward to